Now, the housing market and the U.S. economy, they are the topics of the day. President Obama, he is in Las Vegas, and in just a short time, the president is going to detail his latest plan in order to help the housing market. Las Vegas has been hard hit by foreclosures. Nevada has the highest foreclosure rate in the country. Also, housing prices, they remain depressed in the region. My guest, Chris Rupkey, Managing Director, Chief Financial Economist at Bank of Tokyo-Mitsubishi. Good to have you with us, Chris.
Glad to be here.
What do you make of this new plan in order to help homeowners that have not been able to refinance because of the imbalance in the value of their home and how much they owe to the banks?
Well, I mean, they've tried it before. I don't know quite why it's not going through. I know one issue that all of Washington is talking about is the fact that it's hard to get refinancing money right now. And obviously, if you're underwater, you're not going to be getting money to refinance your home. So I guess this program's okay to try and jumpstart that. I think the issue here is that housing led the economy lower a year before the start of the recession. A lot of people think, and they're being advised, the administration, that if you can't fix housing, you can't fix the economy, you can't generate jobs. So I think that's where this stems from.
But maybe
I'm usually an optimist, so I don't want to say anything else.
Maybe they should read some of your reports, because the dire straits of the economy are not mirrored in your analysis. You think the economy, while it's not robust, it's growing, and we're not going into a second recession.
I think it'd be more helpful if they stuck with the idea or the observation that they have created 2.6 million private jobs. I mean, you know, that's a start. They're not going to be able to create an additional million jobs overnight. It's going to be I don't even want to say it's going to be a slow process. It'll run something like 100,000 to 200,000 new jobs per month, come heck or high water.
Well done, Chris Rupkey. You've written in your report that surveys are not facts. Explain what you mean by that.
Well, we had this interesting situation where the Philadelphia Fed survey, an area very close to my own home, eastern Pennsylvania, Delaware, southern New Jersey, that area of the country, the business survey of companies in that area plummeted. It fell off a cliff ever since gas prices went to $4 back in March. We had the Japan earthquake. Anyway, it came down 2 months ago. To make shorten up the story, we were in recession territory for that indicator. People said, I have a secret indicator in my pocket that shows we're actually in a recession. Well, that was 2 months ago. Now, this month, was reported Thursday, it went to +8. It was -30. Now it's back on the plus side, +8. So the recession, I don't know, it vanished.
It's almost as if it's as volatile as the stock market.
Yeah, I think surveys, people swing back and forth on surveys. You know how it goes.
Tension on Europe. It's been centered on Wednesday's summit meeting in Brussels, where European leaders hope to unveil a €1 trillion plan to bail out Greece. That's about $1.3 trillion US. Now, talk about Europe's debt and the U.S. housing crisis. Let's bring in our guest. We have Chris Rupkey, Managing Director, Chief Financial Economist, Bank of Tokyo-Mitsubishi. Surveys are not facts, he says. Also joining us, economist Gary Shilling, the president of A. Gary Shilling and Company. He was an economist at the Federal Reserve Bank of San Francisco and Bank of America, and we won't hold that against you. Gary Shilling, good to have you with us. So are you still bullish on U.S. Treasury bonds?
Yes,
I got to put it there.
Yes,
really?
I am. I think the 30-year bond, which is now about 3.2%, I think it's going to 2.5%. That's a low in yield, high in price we had after the Lehman collapse in 2008. And the reasons are, first of all, I think the world's economies are slowing. Whether we have a recession next year or not is in the lap of the gods, but the economies are slowing. Secondly, Treasuries are a safe haven, and the euro crisis doesn't show any signs of being resolved. I mean, they keep postponing. The bailouts get bigger and bigger. And finally, even the Fed is worried about deflation now. If you read the minutes from their September 21st meeting, they said that they were embarking on the Operation Twist because they wanted to keep inflation in the zone they wanted. Well, they're not worried about it being above if they're going to be pushing down long rates. They're worried about deflation.
All right, well, I want to follow up on your first item. This is the idea that the global growth in the world is slowing. Chris Rupkey, based on your analysis of the information, we may not have a robust economy, particularly in the United States, but do you really see us having slower growth?
Oh, I don't. Anything can happen. You know, people are starting to mark down the credit crisis in Europe. Will that cause European growth to go negative? But we just had the latest IMF forecast, and they're quite gloomy and doomy by nature, especially when they leave the IMF, they get even more gloomy. Their estimates for world growth are only 4.0 for next year, and then I think rising in 2013 to 4.5. So it's nothing like what happened after Lehman, where world growth went negative. I don't know how much growth is going to slow. I'm looking for higher rates, stronger economies.
So can I prod you into getting your thoughts about the 30-year Treasury? I mean, Gary Shilling is bullish on it. He says that one of the reasons is because we're going to get slow growth. That typically would be good for that kind of bond,
Well,
right?
the producers told us to agree with each other, so yeah, I can pretty much. No, absolutely not. I'm looking for higher yields, especially for 10-year Treasuries. It was ironic they came out with Operation Twist, $400 billion, September 21. 10-year Treasuries closed at 1.93 that day. Now they've drifted up. They're 2.2 something. I would look for, I think yields were down at this level for emergency, end-of-the-world reasons, also known as Europe was going to implode or the currency would fall apart. And now that the danger zone is no longer a danger zone, I expect yields to rise.
Gary Shilling, you don't think that the European policymakers are going to get any kind of control over what's going on in Europe? I mean, they're going to meet in Brussels on Wednesday. They've got a bunch of different plans. They're going to lever up the EFSF. They're talking about 440 billion euros. Turn it into €1 trillion. What's wrong with that?
Wonderful, wonderful. But let's go back to May of last year when they bailed out Greece to the tune of 110 billion euros. And they said, that's it. Greece is going to get its house in order. They're going to actually pay their taxes. The public employees are going to work. They're not going to steal as much. And they're going to be able to go back to the public markets in a couple of years. Well, what happened? A year later, they talked about Greece bailout 2. That was in July, and that was going to be 109 billion. Now they're talking about obviously a lot more than that. I mean, where's the end of this? And of course, it isn't just Greece. It's the contagion problem. It's the risk that Spain, Italy, now even the French banks are under big fire. So this is a huge problem. I think the politicians, this is my own assessment, that they are doing what politicians are supposed to do. They are trying to build a consensus. Chancellor Merkel has a big problem with the German voters. They don't like to continually bail out the profligate Greeks. And so she's trying to wait till there's enough of a crisis that she can bring her electorate along and then say, hey, we saved you from another one, a big cliffhanger. But I think that's why.
But do you think that's going to happen? I mean, that sounds like a plausible
really
scenario.
There really isn't, because they've got two choices. One is they continue to bail out the Club Med South, and this is the Teutonic North who's doing it. But that never ends. That's, to use the current trite phrase, kicking the can down the road. Or they do nothing. Greece defaults. They probably withdraw from the Eurozone. They devalue. They go back to drachmas or draculas or whatever they call the currency. And then, of course, the contagion spreads. Everybody says, who's next? They pull money out of all the banks. And guess what? The Teutonic North is either going to bail out these countries directly, or they're going to have to bail out their own banks that have heavy exposure to these countries. So there's really no good solution. I think they'll continue to try to postpone it. And after all, any politician says, my life expectancy as chancellor or whatever is probably 2 to 4 years anyway. After me, the deluge, as somebody once said.
You're making me feel like Halloween is already here, then. This is the trick part. I don't know where the treat is. We're going to have more. He's talking about the administration's new plans to help homeowners refinance their mortgage if indeed they owe more than the house is worth. There are also some other preconditions. Let's find out whether this plan has any hope of passage and what it would mean for the U.S. economy. We have as our guest Gary Shilling. He is the president of A. Gary Shilling and Company. Also with us, Chris Rupkey, managing director, chief financial economist, Bank of Tokyo-Mitsubishi. And joining us now, Richard Ross, global technical strategist at Auerbach Grayson. Gentlemen, you heard what the president had to say a little bit. You've read the details of some of the parts of the proposal to help people refinance their mortgages if indeed perhaps they have not been able to because of either appraisal costs or financing costs. Gary Shilling, do you think an idea like this is going to get anywhere in the body politic?
It may get some votes. I assume it's an election speech. But the point is, in the housing bubble, when underwriting standards virtually disappeared, a lot of people who couldn't afford chicken coops ended up in 4-bedroom houses. And they're in those houses now, whether they're meeting their mortgage payments or not. They really can't afford them. And you look at some of these programs we've had in the past. HAMP and HARP and so on, and the redefault rate on those in 90 days is horrendous. So it really doesn't change anything. And another thing that they don't seem to pay any attention to, in Washington at least, is that this is a zero-sum game. If people refinance their houses and have lower payments, then they're paying less interest. And who's on the receiving end? A lot of retired people who depend on various mortgage-backed obligations and so on, governments, investors all over the world.
Pension plans, for example.
Yeah, right. So it is a zero-sum game, and of course they conveniently forget about who the losers are in this episode.
Richard Ross, talk a little bit, if you can, about this program, but in the context that if you are already paying your mortgage, which is a precondition to qualify for this new program, why would you then want to go and refinance if you already can afford to pay your mortgage?
Pimm, that's a fantastic question. And as you know, that's why we focus on the reality over the rhetoric. We're getting a lot of rhetoric out of Europe, a lot of rhetoric here in the United States. We follow history, not hope. That's what's fueled this surge in risky assets over the past 2 weeks. But our analysis continues to suggest that that structural trend is now down. You want to be a better seller into this recent strength.
Seller into strength. I got a feeling that you're not very bullish on credit right now.
No, I'm not. And ironically, you see stocks like MasterCard trading at 52-week or all-time highs. In fact, you see a large portion of the consumer discretionary stocks at a multi-year high or an all-time high. I call this my let-them-eat-cake market because it's the luxury high end that's keeping us, that's defying gravity here.
A let-them-eat-cake market. Chris Rupkey, if you take a look at retail sales, not only at the top end, but even at the bottom end, they've been pretty good as gasoline prices have come down.
Yeah, the economy seems to be doing a little bit better. Don't forget, during the first half this year, we slowed to the stall speed 1%, where bad things like a recession could happen. We could flip over and go negative. But yeah, right now it looks like with the GDP in the third quarter, spending is going to come back to something like 2.0%. It's not normal, which is 3.5%, but 2.0 is better than 1% stall speed.
I love your ray of hope. I want to thank you very much. Chris Rupkey, Bank of Tokyo-Mitsubishi, Richard Ross, Auerbach Grayson.